And if you're super clear on what matters to you, and you can think in terms of what's the highest probability that I get the things that matter to me, it'll start to inform some of those decisions.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? And welcome to today's show on Wealth Strategy Secrets. We've got another awesome show for you guys today. Today, we are joined by Nic Peterson. Nic is a seasoned entrepreneur who has built and sold several companies and currently runs the Wolf Den, a community for crypto investors. Over the years, Nic also ran a top mastermind where he was able to learn similar patterns and trends of successful entrepreneurs and investors that he was able to bring together as the basis for his book called Bumpers, which is essentially a guide on how to avoid losses. Nic, welcome to the show.
Yeah, man, I'm glad to be here. It's be fun.
Yeah, you bet. You bet. Super excited to have you on the show, Nic. I know you're really going to have people thinking about their thinking by the time they finish this episode and really seeing things in a different light, right? And that was one of the first things, when I had first heard you talk, that I felt was so, parallel and really intriguing is just the way you're actually thinking about wealth, the way you're thinking about value creation and what's really important. Because I think too many people just get really caught up in chasing a shiny object, or they heard about this investment. They heard about, the latest in crypto, right, from their buddies. So, hey, I got to get in this, fear of missing out. They want to kind of jump in, or whatever the asset class is, right? It's just kind of all the psychology of it. And I read your book, Bumpers, which I think is really fascinating way to kind of, look at it. And I know you have a lot of strengths around really systematizing businesses as well, and then how that really applies to investing and theory of constraints. So why don't we start to unpack some of those and just to level set for, folks who don't know who Nic Peterson is or haven't heard of Wolf Den or maybe one of your other businesses, you could tell us a little bit about how you got here.
Oh man, that is that's quite the story. I haven't practiced. I don't have the Brendan Burchard, trauma story dialed in yet. But yeah, I mean, right now I have just a little bit of background. I have a portfolio with 9 companies in it currently, and 4 of them I own and operate. They're all different kind of domains, different industries. And the way that I ended up getting here is I have an operating system, which you're familiar with if you read Bumpers, like the kind of the base of that operating system, and realized years ago that there's nothing new under the sun. It's like the same stuff over and over. And when you get into these so I started in fitness, then got into exercise with a gym and then a nutrition company. And then I had a third business coaching other people how to do what we did. And that sold for $56 million. And all of these people came from all these other worlds. I used to have a client that's a farmer from North Dakota. They're like, hey, I have a farm. Can you help me? It's like, I don't think so, because I've never had a farm. And as we're talking, the language is different, but I realized, you have a different language for it. But this is the same patterns. These are the same things. And most of the time, it's less about knowing the technical details. So if you talk to investors, there's however they invest, whatever the criteria is, whatever the technical details are, and people get lost in all that. There's another side of that, and that's the human doing the investing. I call it the adaptive dilemma, where it's, you can have all the best theories in the world, but if your amygdala gets hijacked and you make impulsive decisions, then the plan doesn't really matter because you're not following it anyway. And so I started developing this in fitness, realizing that people have a plan and then there's what they do. And they're 2 different things. And they're most of the time completely unaware of the gap between what they plan to do and what they actually do. So they do whatever they do. they're not aware of the gap between, what they did versus what they're supposed to do. So whatever the outcome is, they think that's a byproduct of the plan. Like they're gauging the efficacy of the plan based on the outcome, which is nonsensical because you didn't do the plan. You followed it 70%, 72%. And so it's just observing that we all engage with business, fitness, investing, our family, and we have these plans and these feedback loops where okay, I tried this and this is what happened. And it's just recognizing that you didn't try this. This is what happened, but you didn't try this. You wrote this down and planned on doing this, but you did something different. And until you recognize that, your feedback loops, especially in terms of getting what you want, they're going to be broken. And so I've took that in fitness, went into business. I started a mastermind, and my rule was this, and I didn't want a mastermind. I just had a line of people ready to pay for it. So sure. My rule was this: no two people in the same industry that do the same thing. I didn't need the money and I get bored easily. So I wanted to see all these different domains, how many things can we, how many patterns and principles can we identify that cross over into these other domains. So it was 36 grand a year. And in the first month, I had 44 people. It's 44 people that did 44 different things. And I did that for 2 years. And I spent all day, every day, just because I was fascinated with everything going on. Just identifying these patterns that show up over and over and over, regardless of what domain you're in, what you're selling, what you're investing in. And through that, the most interesting, the ones with the most alignment out of those 44 people, I started pulling partnerships, started partnering with them. And that's where most of my companies come from now, is just say, hey, I want as many diverse, different people as possible, coach them. And then I just kind of wound down the coaching and focused on the handful that I think are doing something really cool, really interesting, really impactful. And that's what Bumpers, R3, everything that I write about, fundamentally, I'm mostly only concerned with the repeating patterns. I don't get super deep into if you're in medicine, there's things that apply to medicine and only medicine. It's not me. I'm not a doctor. I don't need to know all that stuff. But those experts do tend to miss the fundamental recurring patterns. And that's, I think, where I am the most helpful or useful to them.
Yeah, really fascinating. And so would you say all those patterns are really encapsulated in your book, Bumpers? Would that kind of be the essence of it? Or?
No. But I think if we talk about highest return, I think those are the highest leverage, most common. So in Bumpers, you have appreciate when bad things don't happen, raise the floor, can't win a race you don't want to be in. Those are the first. If you want to get from A to B, it's really helpful to not get blown up, step on a landmine. And it's really helpful to actually go in the correct direction, Yeah. So those are the two things that if you can just avoid dying and you're pointed in the right direction, and you're the kind of person that's probably listening to this podcast, you're a driven person, those two things are enough. Just don't go the wrong direction or kill yourself. Yeah. So why don't we just unpack that a little bit more for the listeners? Mm-hmm. So if people haven't read the book yet, let's just get into a little more detail on Bumpers about, killing yourself. And also, it's a really interesting concept, but I was also kind of, contemplating that as well on some of the other, theories that are out there, things like, yin and yang. And there's so many versions of reaching peaks. Then you've got lows, and that's kind of life and kind of managing that. So tell us a little bit about Bumpers. Yeah, I love that you mentioned yin yang theory, because I have a grandmaster, so I have to study all 5 phases of yin yang. Yeah. Yeah. So Bumpers it's one of the recurring patterns, and I saw this first in fitness, and I'm really grateful. For a while, I was embarrassed, being a fitness professional, because they don't always have the best reputation. But I'm so grateful that I learned everything I learned in the context of biology, because it's a complex system, it's adaptive, and so if you can learn through the lens of biology, complex systems start to make more sense. Things like emergent properties and et cetera, et cetera. So watching these gym goers, my clients at first, you recognize, and I'm a resource allocation guy. I learned really, really young when I was going, I went pro in strongman, and my coach told me, gave me this whole spiel about how important it is to conserve energy. And it really stuck with me. So from a resource allocation standpoint, the number of people that yo-yo diet, so they gain 30 pounds, they lose 30 pounds. They gain 30 pounds, they lose 30 pounds. And you see like the tremendous amount of resources that go into losing that 30 pounds each time. It's a significant amount of time, effort, bandwidth, money. And so from a resource allocation standpoint, it was like, what is going on? Because if you could put all of that effort that you've put into losing the same 30 pounds over and over to making progress, you would be so much further along in such a better place. And that's where it's like, that's the pattern we kept seeing is, okay, so you had $1 million month, and then you had 2 months where you lost $1 million, and then you had $1 million month. It's like, well, if you could just avoid the losses, or in the first case, if you could just avoid the weight gain in the first place, you could recapture all that time, effort, money, and resources and put it into inching forward and making progress. So why aren't you doing that? And my observation, and I talk about this quite a bit, is if you have a family member that is pre-diabetic and has maybe struggled with their body image and weight for some amount of time, and they lose 30 pounds, what happens? They celebrate, you celebrate, everybody celebrates. It's a massive dopamine hit. And then let's say your sister never gained the weight to begin with. Nobody's celebrating her, right? There's no dopamine for avoiding bad stuff. And so what our brains learn over time is if I want a dopamine hit, I could just dig a hole for myself and dig myself out. Ooh, free dopamine. Whereas making progress is, as you know, it's hard, it's painful, there's not a lot of rewards. So a lot of people get stuck in this loop of, it's like the entrepreneur shows up at the office and starts a bunch of fires so that they could put out a bunch of fires and go home feeling like they're a superhero firefighter. And so I just see this pattern over and over, which is why I wrote Bumpers, was just saying, hey, can we appreciate, I understand why we celebrate getting out of a bad situation, but that's still not ideal because you were in a bad situation. You lost time, you lost money, all that stuff, probably damaged relationships. Can we celebrate or like rewire our brain to at least appreciate when a bad thing doesn't happen? And that was most of, like, we had people come in for coaching in the mastermind and they would start making progress in leaps and bounds. And everybody, that's why we had so many people come in through referral. Like, what's the magic? What is Nic doing? What secret tip or trick does he know that nobody else knows? And it was like, yeah, here's what we do. We go back, we identify all the bad things that happened, and then we figure out how to avoid them in the future. And that's the secret sauce. So that's really Bumpers, is that kind of foundational. You know how many entrepreneurs, how many people in general, investors, they want, so they're looking at crypto, they're looking at AI, they're looking at high upside assets because on some level they're trying to push harder on the gas. They're trying to get to wherever they're going faster. It's like, okay, I get it. But maybe we should take our foot off the brake first. Like that's what Bumpers is. Just take the e-brake off, then push on the gas. And it's been surprising. It's surprising to me. I wrote it 6 years ago. It gets more and more popular. So I think hopefully people are starting to appreciate, or at least think about, avoiding bad things.
Yeah. No, totally love that, Nic. And I really recognize that pattern in investing. And that's when, in 2000, when I took a complete bloodbath in the, when the tech bubble happened, right? And, the market just kind of blew up. And I was in the tech industry, so I was heavily invested in it. I believed in it. But I really recognize this pattern that I think a lot of people don't see on the, equity side of the equation, which is that, one of the biggest, wealth destroyers is actually, stock market losses over time, right? So everyone thinks about, hey, last year it was 15%. It was great. Year before it was 18%. We were up 12%, right? We're doing great. I got that statement and everything is good. But they forgot that like in 2008, when the market was down 30%, that takes your compounded number of where you were, brings it all the way down. And what you have to do just to even get back to where you were takes like an enormous effort, right? And that ties exactly to your metaphor, right, of losing weight. It's the exact same thing with investing. And it's all the psychology of it, but people just, they lose like every time, right? I mean, that is really investing.
Yeah. And like I said, it's the same stuff over and over. And the interesting thing about investing is, from my perspective, and I deal with quite a few investors, and this is very intelligent people, by the way, that struggle with this concept, which is risks and probabilities. There are no certainties. So it's always, in my mind, it's always risks and probabilities, right? Like that's what we're processing when we're investing. And okay, I got 18%. Okay. Does that fund your life goals? Like, no. Well, then it doesn't really matter, because the purpose of all of this is to fund something, I assume. And there's this concept that this is our operating methodology, is we actually figure out what we're trying to fund and in what timeline we want to fund it. Like, I'll turn it into a multivariable equation. And I'm totally going off script. This is not what we were going to talk about for listeners. But investing came up. So this is how we think about appreciating when bad things don't happen in regards to investing. Is, I'll give you an example. Somebody said, where should I put my money? And we just saved her $130,000 a year, just going through recapture, reallocate. She's done really well. So we found $130,000 a year. And that is, I said, what's the most important thing to you? Because all I care about is that you get what you want. I don't care about anything else. She said, the most important thing is my son is going to college in 4 years. I want him to go to Switzerland. I want to be able to pay for it, and I would love to stay with him. I said, okay, how much is that going to cost? She goes, I need an extra $400,000 above what I have in the account for that now. I was like, cool. We just saved you $130,000 a year. Over 4 years, you're already there. Like, you just take that money you saved and put it in the account, and the most important thing to you is locked in, 100% probability, and it's all probabilities. And she's like, okay. And 5 minutes later, where should I put that money? In the bank account is where you should put that money, because it represents something that's important to you. And she says, well, I think about real estate. What do you think about that? What is the probability that, so if you take that $400,000 extra, you put it in real estate, the probability that you get what you want has gone down. Now, that real estate might 10x in 10 years. And that's really tempting because it's more, it's bigger, it's opportunity. However, the probability that you get all of that money out in profit in 4 years is relatively low. So you're actually putting the important thing at risk by trying to make more. And that's kind of the whole, how do we appreciate when bad things don't happen? What's the most important thing? This. Well, then fund it as soon as possible. If you want to fund it in 2 years, don't put that money somewhere that's going to take more than 2 years to mature. Because it might be more, but you've decreased the probability you get what you want. That's kind of the game that, how do we appreciate when bad things don't happen? Don't do things that lower the probability that you get what you want.
Yeah, that is so spot on, Nick. So in my book, The Holistic Wealth Strategy, it's exactly what we talk about, which is really creating that vision for yourself first, right? Before you look at any investing, no matter what your numbers are, it's getting crystal clear clarity on, your freedom of purpose, your freedom of time, right? Your freedom of money, and what is it you're looking to do? Because everyone's got something that's, different for them. But I love how you framed that in terms of, certainty and probability. Do you have some type of model that breaks that down further? Like if you're thinking about kind of an asset allocation model or something to morph that to?
Yeah, we do. I'll do my best to explain it. And then, even separately, I can shoot a Loom video or show you the tools and all that stuff.
Awesome.
It starts with, it starts with what we used to call the solvable problem. They still call it the solvable problem, but I sold that company and it's trademarked, so I don't use it anymore. Which is, it's really getting clear on what's your number one priority. And okay, so number one priority is you want to pay off your mortgage. You just want that done, and that's the most important thing to do. Cool. How much is that? What timeline? So now we have this problem that we can solve for. And here's the high level overview: where you're at, where you want to be. And we only deal with one priority at a time. And I'll explain why. This is totally just my preference. I'm not a financial advisor, all those disclaimers. I fund one priority at a time in the order that I prioritize it. Because if you think about, if you have three priorities and you're like, okay, I'm going to put a third of my money here and a third of money here and a third of money here, and in 9 years, I'll fund everything. And like, yeah, in a vacuum, that might work. So 9 years from now, however, let's say 4 years in or 3 years in, COVID hits. Well, now you're up Shit's Creek without a paddle and you have three things partially funded with no path forward. Had we funded entirely the number one priority and then COVID hits, you're up Shit's Creek without a paddle, but at least you got the most important thing to you. So we waterfall. And the way we do that is number one priority is X. Like, my brain says you can have it all, but let's assume that time is going to pass and randomness exists. So if you could only have one, what would the most important thing be? Boom, that's number one. And that's always hard because nobody ever wants to admit what the most important thing actually is. Whole different story. So then we say, okay, so given where you're at and what you make and yada, yada, and this is where we flipped the math on its head, is so I'm here, I want to be here in 4 years. That's my number one priority. And given where I'm at today, I need 11% a year. So that tells me the kind of risk profile that you should be playing with. If you need 11% a year and you're like, I'm going to go to crypto, I'm going to be like, yeah, you don't need to take that kind of risk to get 11% a year. So, if you need 3% a year, like, cool, bonds, I don't know, probably get that in the S&P. So that's okay, I need 11%. And let's say I go into an investment that I think will get 11% a year and it overperforms. It does 17% on the first year. We would take that 6% overage and either take it off the table or flip it into something less volatile, less risky, which is hard because everybody wants as much as possible. But we're saying, no, take the overage, take the overperformance, stash, because we're playing the game of increasing probability. We're not playing the game of as much as possible. Right. So then you do the same thing and you say, this is really your number one priority. And you say, yes. And we say, okay, well, you're going to need 37% a year to fund that. So one, can we increase your income? Can we find another way to make that number smaller? But let's say you need 37% a year. You're going to have to you're going to have to take more risks. And I don't consider it risky because the biggest risk is that if you need 37% and you put your money into something that's going to get 8, you are guaranteeing you don't get what you want. You've driven the probability down to 0. So the way that we process risk, it depends on what you need to get what you want. If you need 37% and all your money is sitting in something that gets you 6%, that's the riskiest thing you could do. You're just guaranteeing you don't get the most important thing to you, which doesn't make sense to me. So that's kind of our model, is like, can we figure out what kind of return we need to lock in the most important thing? That will inform us to some extent the timeline, and it informs us what options we have. If you need 7%, you got all kinds of options. If you need 2%, then I would wipe most of those options off the table because they're too risky. If you need 45%, you wipe all the safe stuff off because you got to get 45%. And so we do that, take the overage. There's 3 things that we do with overage. And I'm very simple. I'm not a complex guy. Take it off the table, put it under your pillow if you want. Flip it into something less risky, bonds or something. Or you could take that overage. If you want to collapse the time down, you could take your big bets with that 6% overage. House money. So do that with the first priority. Once the first priority is funded, roll it down to the second, the third, and systematically try to lock in the things that are the most important to you with the appropriate amount of risk, which is totally relative to where you're at and what's important to you. So.
Yeah, it's such a top-down approach, right? That's very strategically thought out, but majority of investors come bottoms up because they're just looking at the specific investment themselves, and I've got to be in this or I've got to be on that because of whatever's kind of driving them. Or to your point about the amygdala saying, I just need more. That one sounds better.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
But this is so purpose-based. And we kind of think about that as, from an asset allocation model and, talking to a lot of family offices and everything, we really think of it as a pyramid, right? And the pyramid at the base level, you have your lowest amount of risk and you have the most amount of certainty, right? And then as you move to the top of that, at the top of the pyramid, you've got your highest amount of risk, right? And it's really speculation. And that's where I see some of the, crypto kind of sitting up there, right? Where it's, much higher returns, or businesses even, right? Or angel investing, right? Because you have no control with that. So do you have any other, actually, let me ask you, Nic, what is your Colby score? Do you know your Colby score off the top of your head?
Oh, it's funny because Justin Breen, I don't know if you know Justin Breen.
I do. Yeah, I do.
He's at my office right now. He's upstairs. And he's a freak about Colby scores.
Yeah.
I've sent him mine. I don't remember the order. I am an 8 quick start and a 7 implementer, and then follow through and fact finder or low.
Oh, interesting. Okay, so I would have guessed that you were a long follow through, because the way you're really systematizing your businesses and the way you've picked up on all these patterns. Because I'm a 7 follow through, and so if any of the listeners haven't done that, just totally recommend taking this. Go to Colby.com. It's a 20-minute test, and it just unpacks your really instinctive nature, right, on how you're wired. And I think this applies to investing, entrepreneurship. I mean, you name it, so much. And I was actually in the tech industry doing a lot of process consulting. And so to me, understanding this and knowing that I'm a systematized thinker, it really explains exactly why I've been trying to systematize wealth building for so long, to your point, right? It's a process. So if you get on the scale and you're trying to lose weight and you're chasing that number, it's completely volatile. But if you just focus on the process and then you have your purpose aligned, as you pointed out, right, you're much likely to achieve the results.
Yeah, I agree. And I tell people this all the time, is I will appear, if you followed me around day to day, I do look like I have high follow through. But it's because I know that I don't, that I actually engineer systems, and I'm an implementer. So I got to touch stuff. And so I engineer systems to put problems in front of me, and I can't help do something about it. And so I engineer follow through by making it I piggyback off my quick start nature. So it's like the same stuff, but it feels, I built a system where it shows up to me randomly and it's like, oh my God, I got to fix this. So it looks like a high follow through, but
right.
That's why I have to system my stuff that way. Otherwise it'll never, ever get done.
Yeah. Any other, systems or patterns that you've recognized, right, from your businesses that you're applying to your investing now?
Yes. The biggest one, I built my whole portfolio this way. And you can learn more about it from Nassim Taleb in Anti-Fragile, in all of his books. I don't know that he talks about it in Black Swan, but it's the concept of He calls it the barbell. It's a bimodal strategy. So it's Seneca's bimodal risk mitigation strategy, which is you got on one side your extremely high upside investments or activities, and on the other side you have your reliable ones. And people always, especially in the entrepreneur world, they confuse the barbell all the time. I did not say passive, I said reliable. And they are different things. So everybody goes for passive. Your upside stuff, your reliable, it could be passive or active in either scenario. But what I'm looking for is things that have a tremendous amount of upside. The mere fact that they have so much upside, we know they're not reliable. And then you have reliable on the other side. So in a business context, a lot of people start a business because they think that it has infinite upside, and they learn really quickly it doesn't, like an accounting firm. This relational business, it doesn't have the scale that everybody thinks it has. So it's not an upside play. And it's not reliable in the sense that, could you tell me next week, how many hours are you going to be in the office? What are you going to do? What's the outcome going to be? I'm like, I don't know. I just show up. And so it's not reliable. It's not going to function without you. And even with you, it's variable. The outcome's all over the map. So it's smack dab in the middle of the barbell, which means it doesn't have upside, nor is it reliable. It's a job. I don't want to be in the middle of the barbell ever. And our human instinct, it just pulls us to the middle, because the upside stuff, we want more certainty. So we try to pull it toward the middle. And the reliable stuff, we want to be exciting. So we keep fucking breaking it, and it goes to the middle. So we keep having, our human instinct keeps pulling everything to the middle. And I'm actively pushing everything out. It's either an upside play or it's a reliable play. In our businesses, it's like, hey, these are liquidation plays and these are cash flowing plays. If it sits in the middle, it's neither. It's not reliable cash flow. It doesn't have upside. Therefore, it should not exist. So investing, I actually look at the same way. I built my portfolio based on our investing strategy. So a handful of my companies are specifically, I don't care about the enterprise value, because the role that they fill is reliable cash flow. And then other companies, I don't care about the cash flow, because the role that they fill is massive exit later. So investing is the same kind of, back to, let's say we need 11% to reach all of our goals. What I would do is I would try to have things on the reliable side that have an expected value of greater than 11%. Right? And that overage, if it was me, I would flip it over into investments on the other side with tremendous exit capacity. Because probabilities and risks, if I say I want to get from A to B in 6 years, and if I get 11%, I'll do that. So I want this really robust, because I want certainty that in 6 years, I'm going to get everything I want, worst case scenario. But if there's overperformance, or I get a tax return, or I get anything above that, I'm going to put it on this side of the barbell, because one liquidation event can take, so on one hand, one side of the barbell gives me certainty that I'm going to get what I want. The other side allows randomness to potentially collapse that time down from 6 years to 3. Right? One big exit, and like, boom, you're there. And so that's how I build everything. But for an investment strategy, I want the reliable side to fund everything that's important to me in the timeline that is fair and appropriate. Like worst case scenario, if I get all this stuff in 10 years, it's fine. It's not ideal, but it's fine. And then I let the randomness of the high upside, so crypto falls in the high upside stuff. Bitcoin goes to $1 million. Shit, it is sweet. Reached all my goals faster than I expected. But even if that didn't happen, I locked it in through the reliable side. So it's just a bimodal strategy. I just fight like hell to stay out of the middle. If it doesn't have massive upside, it's not uber reliable, then it just doesn't have space in my investment portfolio.
Yeah. No, that's such a great way to think about it, right? And just, create that certainty, because I really think about just, the psychology of, why are you making an investment? And I think people don't ask, like, why? Like, what is this going to do for me? Like, ask why until you can't ask why anymore, to keep kind of drilling down, right? And oftentimes what you'll find is, to your point, right? It's actually trying to create certainty out of something, right? Because they're in a job that, is might go away or something, right? Or maybe you're having a child come on the way and you'd like your wife to stay home with the child or one of the parents, right? So you're trying to actually gun for that. So creating the certainty to do that definitely gets you there, right? And then you get to pick your investment vehicles and asset classes that will support that, right? So tell us a little bit about from a crypto perspective, right? And we don't really need to get too deep in the weeds, on this. We do have a ton of tech investors and entrepreneurs in the community, so I think everyone has good base knowledge. But just give us a little bit about the state of the market and crypto, kind of where you're seeing it, trend right now.
Oh man, so I'll do my best. You got crypto. I know a lot of people that invest a lot of money into blockchain, but they're not buying cryptocurrencies. And so there's like that distinction, which is there's the blockchain, which is like the underlying tech. It stores data in blocks instead of columns and rows, And then you have the assets that live on the blockchain and are transferred on the blockchain, the cryptocurrencies, the NFTs, and all that stuff. Investing in blockchain right now, if you have a long enough time horizon, is probably a really good idea. There are so many companies that, like IBM, built a blockchain. So if I was dabbling and I didn't want to get left behind, which is where most people are, I wouldn't go buy crypto personally, unless you're prepared for the vicissitudes of what is crypto right now. But you can find really great companies, IBM, Microsoft, et cetera, that are building in Web3 on the blockchain, et cetera, because it will get reflected in their stock price, and you don't have to deal with all the volatility that comes with crypto. So that's the first, just speaking to those that feel like, I'm going to get left behind, and so that they're leaving their comfort zone to go buy crypto. I'm telling you right now, if you buy crypto because you have FOMO and you have not experienced 70% drawdowns before, don't buy crypto. Find a company or like an ETF or something, like find something more familiar. So I do think investing in companies that are tinkering on the blockchain as a tech is a good move. I really do. Those are the same companies that are tinkering in AI, and they're probably going to combine the two to do some really cool stuff. And it won't be as sexy or fun as Dogecoin, going a gazillion X, but it'll probably get reflected in their stock price, and I think people would be happy with it. Now on the crypto side, NFTs right now, great. Inherently, there's no value to NFTs outside of there's some utility and like the provenance and the royalties and all that. So NFTs, it's like, I would look at, do I just believe in this project? There's fundamentally, there's no value to NFTs unless it's totally subjective. Cryptocurrencies, that's the interesting thing to me, because what a lot of people look at crypto and they look at it like they would invest in Apple. What's interesting is that when you invest in Apple, you're not investing in Apple thinking that a whole bunch of other people are going to buy Apple necessarily, because there's an invisible third party. The people standing outside the Apple store to buy an iPhone, they are participating in the market, but they're not buying and selling stock. So crypto doesn't have that third party participating yet like equities do, or even commodities. Like commodities, somewhere the rice is getting delivered and cooked and eaten. And so there's not really a third party participant yet, which makes it highly, highly speculative. And I think everybody knows that. The other thing about crypto is, for the most part, the commodities market exists for bona fide hedgers, for people that want to stay in business. And most your listeners are probably familiar with that, right? So the commodity market exists for bona fide hedgers. They allow speculators to participate, so there's sufficient liquidity. Equities exist so that you could invest in companies. You could have a piece of these performing companies. Crypto is different in the sense that there's no equivalent to bona fide hedgers, and not all crypto assets are built or designed to be investments. They in and of themselves sometimes are the utility. And that's where like I think investors have a hard time. It's like, well, I bought this coin and it didn't go up. Well, it's not designed to go up or down. It actually has a utility. So the reason you would buy this asset is to perform the function that it does. And so I think that's why most people get wrecked, for lack of a better term, is they just go and they look for assets that are going up or down. But unlike any other market that I've seen, each of these crypto assets has a different utility within an ecosystem that you probably don't understand yet. So that's kind of if you get into crypto, the easiest thing to say is like, study Bitcoin. It's been studied for 13 years. People understand it. Elon Musk, Michael Saylor, they buy it. But if you start Ethereum, you can learn a lot about Ethereum. It's mostly publicly available. But anything smaller than that, you start getting into, if you don't understand the utility of it, I'm not so sure it's a great idea to buy it.
Yeah.
Yeah.
No, that makes sense. Do you think it's too late to get into the game for people, or should they have like some, let's say someone is not technically inclined, right, to go really deep in this asset class, but they want some exposure to it. Is there any kind of, general thoughts around that? Maybe Bitcoin, Ether, some kind of percentage or something?
Yes. And this is like, I do have an opinion. This is not financial advice, all those other disclaimers again. I do have a thought on it, but it's kind of like talking about, I was too young, but the .com bubble, it's like you could make sound arguments for a lot of those companies, I'm sure, and most of them don't exist anymore. And that's kind of where we're at with crypto is you could look at the top 20 projects and I'd be willing to bet 5 of them still exist 10 years from now. So just that's kind of a disclaimer in that, like, fundamentally, this is what I believe now. But there was a time where I would have told you there's no way that any search engine ever takes over Ask Jeeves. And who uses Ask Jeeves anymore?
Yeah.
So things are changing so quick. Now, Bitcoin is likely the safest bet. And you can just you can deep dive on Bitcoin all you want. There's a lot of really great information out there. But in my opinion, the question is this: is Bitcoin going away? Yes or no? And I don't want to influence anybody's answer. So that's the first one. Is it going away? Yes or no? My opinion is no. Look at it. It's not going away. So if it's not going away, and there can only ever be 21 million Bitcoin, which means not even every millionaire in the US could have a Bitcoin. That alone tells me it's probably a sound investment. Just know it's not going away, and it's already worth whatever, 60 grand. And I would assume there's going to be a supply demand issue. So that's kind of like the tech doesn't really matter to me. If we're talking about investments, it doesn't matter. Ethereum. So I'll stick with Bitcoin and Ethereum. So I think Bitcoin is a sound investment if you have a long enough time preference, because regulation, all this stuff, it's gonna be volatile. Most things right now, Bitcoin has no utility outside of, it's like having gold. There's not much you can do with it. Slow. It's a slow network. Ethereum, almost everything built, if you look at all the projects, Bored API Clubs, all these NFTs, everything, it's all built on Ethereum. So at this point in time, if anything in crypto other than Bitcoin, if any projects in crypto win, Ethereum wins. And so for that reason alone, it's like, I do have Ethereum. I'd take a bet on Ethereum. If I was going to bet on crypto, I would bet on Bitcoin and Ethereum.
Yeah.
And there's no reason that, unless you have whatever reason you have as an individual, great. But fundamentally, I don't think there's much of a benefit to diversifying beyond those two if you're just starting. The other thing you have to worry about is tracking it all. And Bitcoin and Ethereum are very, very easy to track. You start getting smaller caps, you start losing track of how to check the price, where it's at, how to sell it, how to buy it, all that stuff.
Yeah, and Nic, what's your view on, so we talked about really the speculative nature, crypto, we've talked about the utility of crypto, but how about the perspective of people thinking about it as an asset class that's really a hedge against the dollar?
That's a great question, because I am not, first of all, I am not formally, I have partners that are formally trained in all this stuff. I am not. So for all the investors listening, I apologize, because I'm going to use lay terms. Hedge against the dollar. Here is the issue I have with that concept. Conceptually, I understand. But here's the issue I have with people that want to have that conversation. Most of them cannot formulate a good argument. I'm sure there are plenty of good arguments. When you buy Bitcoin, how do you measure whether or not it was a good investment? How many dollars it's worth? So you see what I'm saying? Like, yeah, we want to hedge against the dollar, but, and you believe that, but my behavior says, or your behavior and your reaction, we go, oh no, I bought Bitcoin and now it's down. It's like, so you wanted more US dollars to hedge against the dollar? Like, how's that different than any other investment? So as long as we are still measuring our Bitcoin, now if we measure our Bitcoin value in Bitcoin, I have 0.3 Bitcoin, and then tomorrow I still have 0.3 Bitcoin, and 0.3 Bitcoin will get me more cheeseburgers today than it would yesterday, or, the same dollar. Like, until you start doing that kind of math and having that conversation, I don't think anybody's actually hedging against inflation or the dollar being devalued, because they're just trying to acquire more dollars based on my observation, right? So
yeah, no, that's great.
It's like any other investment. Great. It's a hedge against the dollar weakening in the sense that you're hoping to have more dollars, but you can't go into Chevron and buy gas with Bitcoin. So for now, I think in time it will prove to be a good hedge, but yeah, that's not people that saying
it's kind of similar. It's kind of similar to how, right, oil has always been pegged to the US dollar as well.
Mm-hmm. So that's the whole, if you're looking at investment right now, my guess is, and I'm only saying this so people can align their strategy with their reality, is people like, I hate the US dollar. Get rid of that trash. And they buy Bitcoin and they go, oh no, my Bitcoin's worth less US dollars. It's like those two things don't live well together. You either hate the dollar or you love it and you want more of it. So it's like these beliefs and actions that are diametrically opposed. It causes a lot of, like, how do you have a sound investment strategy when your beliefs are opposed to one another?
Yeah. Now, and for the listeners out there, the data that I have collected so far on ultra high net worth and family offices has been 1% to 3% on average as part of their portfolio allocation into cryptocurrency. Just as a data point.
Yeah, I think it's great. And I do think that will go up this is why I think everybody, when you mentioned, do you think we're late or whatever, I think we're all still early. Because regulatory clarity, I think, will increase. High net worth people will invest way more when they have clarity on the legal ramifications of investing more.
Yeah. Excellent. Nic, if you could give just one piece of advice to the listeners about how they could really accelerate their own wealth trajectory, what would it be?
A version of what we talked about. I think make a distinction between, let's say, speed, going fast, and velocity, like adding the vector component, like going fast in the right direction. So I think really to accelerate your path to wealth as defined by you, it is take time and gut check yourself on what really matters to you. Like what are the most important things? And I think that will help many people discern like this investment or this one or this one. And if you're super clear on what matters to you and you can think in terms of what's the highest probability that I get the things that matter to me, it'll start to inform some of those decisions.
Yeah. Awesome. So many great takeaways. Really appreciate the insights, Nic. If people want to learn more about what you're doing, with you, Wolf Den, or your companies, what's the best place?
Best place is probably just start with the book. So if you do bumpersbook.com, it'll take you straight to Amazon. And the reason I send people there is because, one, I don't have anything to sell people. And two, you'll read Bumpers. It's super short. And in my experience, you're either like, oh, it's self-evident and you get it, or it's just not your thing. So it's the best filter I have. Like, read the book. If you like it, you'll figure out how to find the rest of my stuff. If not, it's cool. It's 45 minutes of your day. Now you know.
Yeah. Awesome. I'd like to throw something else out, listeners. If you guys could do Nic a huge favor to really thank him for his time today. I noticed that you've got about 85 reviews on Amazon, and as I understand it, the algorithm is about 100 reviews, and then it's gonna move up into the suggested category more. So if you guys please go in when you have a chance to download Bumpers and read it, please give Nic a review on that. If he gets just 15 more reviews, we'll be across. I'm definitely going to do one myself, and hopefully we'll cross that threshold and get a lot of value out of it as well. That's
great. I didn't know that, but thank you.
Yeah, you bet. Nic, thanks again. Really appreciate the dialogue, and really, I think help people, challenge some of the conventional thinking that we're all kind of, subjected to, and really think outside of the box on what wealth really means to you, how you allocate capital, and what's really important.
Yeah, it was fun. And I haven't talked about investing since, it's probably been a year. So it's good to just drum up some of this stuff.
Awesome. All right, Nic, thanks again. Really appreciate it.
Yeah, likewise.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.